All right, let's talk. We need to shift our focus right now. It's not about chasing growth anymore. It's about building a fortress. This isn't just some market update. Think of this as a critical briefing on how to shield your portfolio from the turbulence that's clearly on the horizon. In times like these, the best offense, well, it's a powerful defense. So let's get proactive.
Now, let me be really clear about this. This isn't about scaring you. It's about foresight. It's about looking at the underlying data and acting before a crisis becomes the screaming headline on the front page. You've worked too hard for your savings to not have a proactive defense, and that is exactly what we are building today.
So here's our game plan. It's straightforward. First, we're going to learn how to read the warning signs. Second, we'll stress test our portfolios to find every single weak spot. Third, we'll create a solid defensive plan to get rid of that risk. And finally, we'll talk about the discipline you're going to need to navigate the storm calmly.
Okay, let's dive right into Section 1. It's time to tune out all the daily market noise. We're going to go deeper to look for those structural cracks in the foundation that, frankly, most investors are completely overlooking right now.
Here's the absolute truth about a crisis. It reveals who built their house on rock versus who built it on sand. We need to be looking for companies with solid financial foundations. I'm talking strong balance sheets, positive cash flow. We want to avoid those that look amazing on the outside but are secretly drowning in debt.
Okay, on to Section 2. We're going to stress test your portfolio. But before we even think about what to sell, we have to change how we think. In a downturn, emotional reactions are your worst enemy. Our job is to replace them with a framework of cold, hard logic.
And the very first logical filter we have to talk about is liquidity. For every single asset you own, you need to ask yourself this one simple question. If I absolutely needed cash tomorrow, how fast could I sell this thing without taking a massive hit on the price? You know, a remote vacation property is a perfect example of this. On paper, it might be valued high, but in a panicked market, trying to find a buyer at that price is just a fantasy.
Look at this. This is the big mental shift we all need to make, and we need to make it right now. In a bull market, investing can feel like a popularity contest, right? It's driven by hype, fear of missing out, what looks good on social media. But in a crisis, all of that just evaporates, and all that's left is reality, intrinsic value, cash flow, low debt, and real-world utility. We are moving from the left column to the right, effective immediately.
This brings me to a really dangerous threat out there, what we call zombie companies. These businesses, they look fine on the surface, but they're not actually profitable. They're just surviving by constantly taking on new debt to pay off the old debt. The second interest rates go up, they're the first to fall. You want a quick way to spot one? Go look at their income statement for the interest expense line. If that number is getting dangerously close to their operating income, you've probably found a zombie. It's a huge warning sign.
All right, this is probably the most important part of our talk today. Section 3 is where we stop thinking and start doing. We're going to build a clear, systematic process for removing the highest risk assets from your portfolio one by one.
And if you're wondering why this is so urgent, just look at these numbers. Assets that are driven by pure speculation, meme stocks, trendy collectibles, they don't just take a dip in a crisis, they evaporate. A 90% loss isn't a dip, it's a complete wipeout. Our job is to get out before that floor completely disappears. Okay, this slide right here, this is our playbook. It's that simple. On the left, you've got assets that literally become liabilities in a downturn. They're hard to sell, they cost money to maintain, and they're based on nothing but hype. On the right, you have the assets that provide stability and safety. Our entire plan is about systematically moving your capital from the sell column over to the keep column.
Now, the order in which you do this is absolutely critical. You can't just sell things randomly. You have to start with the most volatile assets, the speculative hype plays, because those can go to zero the fastest. Next, you get rid of the assets that are actively draining your cash, like high-maintenance luxury cars. Only then do you start the longer process of selling illiquid stuff like property. And finally, you rebalance your stocks towards safer, debt-free companies.
Now, we have to be realistic here. As you can see, selling a public stock is instantaneous. But trying to sell a luxury car in a recession, that's going to take time, and you'll likely have to take a price cut. Selling a piece of property can take months, sometimes even years. The goal here isn't to get the absolute top dollar. The goal is to secure cash. Taking a small, calculated loss now is infinitely better than a catastrophic loss later on.
And while we're getting cash in, we also have to stop the cash from leaking out. Think about the passive cash drains in your life. High-fee insurance products, maintenance on things you're trying to sell anyway.
Every single dollar you save from these leaks is another dollar added to your defensive cash pile. It's time to cut them. Now.
All right, I want to talk about gold for a second, because this is a mistake I see a lot of people make. Gold jewelry is a consumer good. Gold bullion is an investment. They are not the same thing. The high price you pay for jewelry includes craftsmanship and branding, value that completely disappears the second you try to sell it for its raw material. In a crisis, nobody pays for artistry, they pay for weight. For true value preservation, only pure gold bullion counts.
Okay, let's move into our final section. We can have the best plan in the world, but it means nothing if we can't stick to it when things get crazy. Let's talk about the mindset you're going to need to stay calm and rational when everyone else is panicking.
This really brings us back to the main point of everything we've talked about today. A crisis is the ultimate test of substance over style. It ignores hype and it relentlessly exposes weakness. Our entire strategy is designed to make sure that when that test comes, your portfolio is one of the very few left standing on a solid foundation.
So, we've sold off the risky stuff. Where does that cash go now? It goes right here, into these safe havens. Notice our objective has shifted entirely. We are no longer trying to generate high returns. We are focused exclusively on one thing: capital preservation. We are building a financial fortress.
And here's a really important warning about where you actually park that cash. In a crisis, you might start to see some smaller, less stable banks offering unusually high interest rates on savings accounts. This is a trap. They're desperate for deposits. Chasing an extra 1% of interest is not worth risking 100% of your principal. Stick to the largest, most stable financial institutions, period.
When it all boils down, this is what it's all about. The preparation we do now, in the calm, is our armor against the panic of the storm. When the market is in free fall and the headlines are screaming, you won't have to think on the fly. You will simply execute the logical plan we have already built. You'll trust your own work, not all the noise.
So I'm going to leave you with this one question to think about. When the storm finally hits, will your portfolio be an anchor that holds you steady, or is it going to be a dead weight that pulls you right down to the bottom? The choices you make right now will decide that answer. Let's make sure it's the right one.